I want to continue my discussion of pension plans by talking a little bit about the regulation of pension plans. Now, pension plans are regulated under the Employee Retirement Income Security Act, or ERISA, of 1974, which sets standards that must be followed by all pension plans. Now, companies that don't follow or sponsors that don't follow the plan may lose their advantageous tax status. Participants must be provided plan summaries. ERISA established guidelines for funding, and in the previous video I discussed underfunding, overfunding, fully funded. Employees switching jobs may transfer their credits from one employer to the next. Now, it also establishes minimum vesting requirements, which I believe I also mentioned in the previous video. The graduated vesting means that the employee is vested 20% per year from years 2 through 6. So after 2 years of service, they have 20% vesting in the pension. After 3 years, it would be 40%, etc., until they get to year 6, where they'd be 100% vested. A plan sponsor can also choose cliff vesting, which is a case that the person is not vested at all until after 3 years of service, and then after 3 years of service, they are 100% vested. ERISA assigned regulatory responsibility to the Department of Labor, and it established the Pension Benefit Guaranty Corporation, PBGC. So this is much like the FDIC for insured banks. Premiums are paid by the sponsors of the defined benefit plans, and there's a maximum that's guaranteed. For 2013, the maximum guaranteed amount is $4,789.77 per month, or $57,477.24 per year for workers who begin receiving payments from the PBGC at age 65. And there's a table. So if you're older, if you're 75 years old, it's quite a bit higher. If you're younger, it's quite a bit lower. The PBGC does not guarantee health benefits that your employer may have guaranteed or may have promised during your retirement, but they just guarantee the vested pension benefits. In 2006, there was the Pension Protection Act, which requires companies who have underfunded their pension plans to pay higher premiums to the PBGC, and extends the requirement of providing extra funding to the pension systems of companies that terminate their pension plans. And let's just hit a few of the highlights of this plan. Requires companies to analyze their pension plans' obligations more accurately. Provides statutory authority for employers to enroll workers in defined contribution plans automatically. Prior to this, employees had to opt in to pension plans, but experience shows that people are less likely to opt out if they're given something as a default. And there's been discussion of this by a lot of people in a lot of different areas. For example, most people believe that being an organ donor is a good thing, yet very few people opt in. Now in Europe, it's opt in unless you choose to opt out. So the default is opt in. So if you don't want to be an organ donor if something happens to you, you can opt out. But most people choose not to opt out. And one of the reasons they did this is many people just were not opting in to these defined contribution plans, these 401k plans. And as they got older, they wouldn't have any money in their account. Now, it's a fairly modest amount that they're automatically enrolled in, but an employer can make it so that the employee, for example, is automatically enrolled to put 5% in their 401k. And they can choose to opt out if they like, but most people don't, or a very small percentage choose to opt out. And this is probably going to help provide for retirement for those people who are rather short-sighted and haven't thought about preparing for retirement. This regulation also expands disclosure that workers have about the performance of their pensions. Removes the conflict of interest fiduciary liability from giving self-interested investment advice for retirement accounts. Gives workers greater control over how their accounts are invested. And finally, it established the safe harbor investments, also known as qualified default investment alternatives, to protect employers from liability of losses suffered by automatically enrolled employees. So this is the case where you have to establish something so that the employees will be invested in something. And if the employer, for example, said, well, the automatic default was to put you all in the company stock, they might be subject to some liability. So here there's some general formula in terms of how the assets are allocated. So the big thing to know is that ERISA is the one that regulates pensions, and that the Department of Labor is the one that follows through on this.